benchmarks extend gains. Banks, pharma, IT, metals pull the Nifty higher. India cuts bond sales ahead of elections. With an eye on fiscal restraint and global index inclusion, India trims bond offerings for the first half of FY25. The world's fastest stock settlement process kicks off. Under the T+0 system, 25 stocks bought between 9:15 to 1:30 p.m. will be settled by the end of the day. Hello and welcome. You're watching Market IQ and I am Pallavi Nahata, your host for the show. I'm joined by Neeraj Shah today. Neeraj, it's indeed a great note to be ending the year on, right? We're looking at the Nifty and the Sensex breaching the day's highs as we speak. And I know, considering it's been a choppy past couple of weeks or so, this seems like great cues.
Yeah, in some sense, a lot of people would attribute this also, typically as it happens the last 2 days of a year, financial year, on NAV management or what have you. But you've seen the small cap index do so well, Pallavi, over the last couple of days. So if you just look at what the Nifty's done versus what the small caps have done yesterday, and the index will come up today as well. While the Nifty is up 1.48%, small caps lagging a little bit today after the big rally that we had yesterday. So that's part one. Part two, if you just look at the weightages of the Nifty 50 and the way they are contributing in the session today vis-a-vis yesterday, because yesterday we've seen, for example, Reliance hold fort, take the markets higher, HDFC take the market higher. We've seen that classic banking rally in the session today as well. Part of it could well be, Pallavi, because of the fact that banks hitherto were underperformers in this take back of AIF, and there was a Citi note on that when the provisions could be reversed. We spoke about it in the trade setup today as well, that maybe some of these stocks could actually see a bit of a leg up. So if you just look at what's done very well today, it's effectively that. But I mean, it doesn't look like a rally which necessarily has legs to sustain. Market breadth also started off very well, and the flash on the graphs are on your screen. It's kind of narrowing down a little bit as well. So that's the other aspect. And the broader end of the spectrum, a lot of stock-specific newsmakers in the session today. But not surprising, the last 2 days, we were kind of setting up for this expiry day. Some of it was anticipated, and it's kind of playing as per the playbook.
Absolutely. But also looking at the top constituents in the Nifty 50, pretty much most in the green in today's day of trade, barring Bajaj Auto, UPL and Axis. Bajaj FinServ, of course, leading the pack. The stock is up by over 4%. Even looking at the sectoral indices, barring Nifty Media, again, most sectors in the green. Nifty PSU Bank leading there, that's up by over 2.5%. Broader markets, like you touched upon, lagging behind, but very much in the green. Both the Nifty Mid Cap 150 and the Nifty Small Cap 250 up by about over 0.5%. But Neeraj,
just the other interesting piece, Pallavi, is PSU banks. Right now, one would expect that with the yields movement the way it is, and I'm sure you're going to be talking about that a bit later on. Yeah. But the yields movement being the way it is, yesterday there was a Nomura note which said that their roadshows suggest that people are warming up to buying PSU banks. Plus, yields moving down is an automatic gain. So, not surprising again that PSU banks are leading the charge today. Again, was on the annual 2.7% by virtue of what the bond yields have done. This was to be anticipated and again has played out very well. What is the only surprising piece is that laggards should have typically performed, and media has been a big laggard, and that is just not participating. So fundamental factors at play when it comes to media. Almost everything else doing rather well for itself.
Right, great. On that note, let's get on our special guest for today, Ajay Bagga. He joins us now. Mr. Bagga, thank you so very much for taking time out on such short notice. The markets, while looking great today, we're looking at a whole host of global cues for the next few months. In trade, there's of course the general elections and all sorts of global and domestic cues, even otherwise. So what's the sense that you're getting? How do you see the markets behave here on?
Yeah, Pallavi, right now, if you see flows-wise, it is a factor of the reallocation globally for pension funds having gone through. So the selling abated. We were expecting that it would abate by Monday, and then going into the year end, because it's a truncated year end, it's a short week, being Good Friday tomorrow. So all global markets also shut down for the year as of today. And that rebalancing of about $22 billion of pension funds because of the 10% increase in the S&P 500 in the first 3 months, we had a reallocation coming in. So some amount of selling pressure was there. If you see last Thursday, Friday, and this Monday, there was enhanced selling in the global markets. That rebalancing happened, and we saw markets going up last night in the US, and we're expecting that going into the quarter end. As far as India is concerned, what are we benefiting from? One, the global macro is quite strong. Second, rate cutting cycle is starting. The Swiss National Bank cut rates, and we're going to see that happen with the ECB and the Fed, be it June or be it August, but it is coming. That is normally quite positive for emerging market flows. The third is the India macro and the corporate earnings story, which remains on a firm footing. So overall, Pallavi, looking at strong markets for the next financial year as well.
Mr. Bagga, good afternoon. Neeraj here. Is the last 2 days the move that we're seeing? Some of it fundamental. I mean, yields moving the way they are, you would expect PSU banks to do well per se. But could it also be attributed to what is classically called NAV management?
Yeah, definitely, Neeraj. Great to be on your show. It is NAV management, and that happens every year. Some powder is kept. And, what happens is the March 31st portfolios are really, skinned to a great depth. And the performance on a year-on-year basis is really watched for allocations by institutional players. So everywhere this data point for March 31st, be it for AIFs, be it for PMS, be it for funds, is looked at quite closely. So we do see some flows coming in, plus the dry powder that funds might have kept is normally utilized during this time. So in the reporting that comes out on March 31st portfolios, you're not holding an inordinate amount of cash on the book. So normally we do see this effect coming in, and that is playing out, Neeraj, quite strongly. Apart from the turnaround in oversold small caps and mid caps, when in a month's time you get 500 stocks going down anything from 25 to 40%, that is a carnage on any market. That's what we went through, and now we are seeing a small bounce, 6% up for small mid caps, which is a very welcome move, but some amount of NAV management and some amount of a natural bounce coming back into the broader market.
Okay, Mr. Bagga, one last question before we let you go. So we're on the last day of trade for the ongoing fiscal, and as we're stepping into the next fiscal, the first, of course, a major event will be the elections and the budget presented thereon. Broadly, there are expectations of continuity in terms of the government as well as the policies. Some of the sectors which we've seen continue to exhibit strong performance this year. Can we expect those to continue to perform as we step into the next fiscal as well? Also, what's your expectation from the markets going forward? Do you see the markets closing on a positive note at the end of the year with solid gains?
Yes, I'm expecting that to continue, and because, unless you get this as of March 31st, all the efforts of the last 2 days would have gone in waste. So I think we will end on a high, as we saw even in the last half an hour yesterday on the penultimate day. So on the final day, definitely you will see buying continuing. In terms of the next year, I think there's political stability, political continuity. So more of the same things. What is returning? I think two big things are returning, and they are the two biggest sectors for us. IT, you saw after the Accenture results some amount of selling, but I've been talking to a lot of senior professionals in our IT companies and trying to figure out the use of AI and how they are now getting into this mode. I think the situation is much more optimistic than what the market is factoring in, and you will see that over the next 3 to 6 months. So I think IT could turn out to be a dark horse. Second is the banks, NBFCs, what Neeraj was mentioning. RBI has given quite a bit of relief. Those provisions, do they get added back? Now we'll have to wait and watch and wait for the operational results, which will start coming out next week, and then for the unaudited results. I think that will give an idea, but I think banks could perform from here on. And the usual things which have been linked to this government, be it capital goods, be it defense, be it railways, we have seen quite sharp corrections. Power, for example, those are multi-year themes. I think those will again get bought into as a new government is sworn in. And a lot of expectations will be on the budget in July. So expect that after 4th June, when the results are over, the big event is taken care of, you could see a surge in the market in anticipation of a very strong budget. The political capital will be at 100% filled up, and that will allow the government to take some measures. And I'm expecting a very big bang kind of a budget, and that will enthuse the markets in anticipation.
Got it. Mr. Bagga, really appreciate you taking the time out. Thanks so much for being with us today and talking about those aspects. Quick check on what do the charts and the derivative positions on the last day of the expiry suggest as well. Rahul Sharma joins in with a quick perspective there. Rahul, great having you. Thanks for accommodating this last minute request. Neeraj here. Good afternoon. But it's turning out to be a very good afternoon for the large caps at least. How do you see the expiry, and how do you see the positions getting carried over and the implications of that for the Nifty or the Bank Nifty?
Yeah, hi Neeraj. Very good afternoon. It's quite closing for the financial year today, and the way Nifty has taken out 22,200 resistance area clearly shows that the market is back into the grip of the bulls. If you see expiry to expiry, we are just like a shade under 2% up. But the way some of these stocks have recovered from the recent correction goes to show the kind of dominance that large caps can exhibit in the series of April. So we are very positive on the sectoral leaders, on the large caps, the heavyweights, and we feel that Nifty is headed towards the next milestone, which is 22,600, and above that 23,000 is a likely possibility in the first half of April itself. So the view remains positive as we cross crucial resistances, and the only pain point that possibly was there was some expiry with volatility, but that doesn't seem to be coming, especially given the way US markets have closed overnight. So net, I think it's a very good expiry, and the momentum should favor the bulls going into the first initial phase of April series.
Okay, so Rahul, we won't take too much time because I understand it's a busy afternoon. What has stood out the most today? I mean, PSU banks are really rocking it on the charts because of the yield movement. Is it that, or is it something else that is likely to, kind of continue the up move?
Yeah, so it's quite a recovery, especially in the NBFC space as well. So not only are the PSU banks doing well, but the likes of Bajaj twins, are back into their good uptrend. And the way the entire market is, especially the market breadth, is pretty solid today. And at the same time, the pain point of the market, which is the small cap space, is sooner than later coming out of the woods and at its crucial juncture of the 50-day moving average. So technically speaking, not only the NBFCs and PSUs have done well, but I think it's a broad-based recovery that is heartening to see.
Okay, Rahul, we'll leave it at that. Thank you so much for taking the time out and being with us and giving us your thoughts. And viewers, there you have it. And some thoughts, both on the fundamentals and technicals and derivative position as well. But Pallavi, clearly, financials, NBFCs, PSU banks, and then banks are just really, really taking it off today.
Absolutely. Well, we'll wait to see how the markets close and what note on. But we have a lot more lined up on the other side. Stay tuned. We'll be back after a very short break. Hello and welcome back. You're watching Market IQ on NDTV Profit. Now moving from the markets to macros, the government published the GSEC borrowing calendar for the first half of FY25. It did throw up a few surprises with a lower proportion of total FY25 gross issuances for the first half of the year compared to past years. The H1 to FY25 gross borrowings is being targeted at 7.5 lakh crore rupees, which stands at 53.1% of the 14.13 lakh crore rupees estimated for the full fiscal year. The benchmark bond yield has reacted to that. We're looking at bond yield on the benchmarks at almost about 7% already. are there chances we're going to see lower yields over the next few months? For that, I'm joined by Vivek Kumar, economist at Quantico Research. Vivek?
Hi, Pallavi. Good to be here.
Thank you so much for taking time out on such short notice. So we're seeing bond yields react to a whole host of factors, including, of course, the government's borrowing program for the first half. Going forward, would it be fair to say that we're looking at a lower yield curve given domestic and global cues?
Well, that's a fair assumption to make, Pallavi, because there are a couple of dynamics which have gone in favor of the domestic bond market. To start off with, the borrowing calendar that you mentioned has an element of positive surprise. It's not that the overall quantum of borrowing is reduced, it's just that the share of borrowing in the first half of the financial year is lower than what the usual trend is. Now, the usual trend is about 57-58% if you look at the last 10-year average of the share of H1 borrowing in the full financial year borrowing. This time around, the share is lower at 53%. So that's a relief, and that relief would be of the order of about 70-80 odd thousand crores. So from a historical perspective, that's the basis for relief in this first half of the financial year. Now, the second aspect is that what's the composition of this borrowing? So if you notice, the government and the RBI put together, they've come out with lower issuances in the less than 5-year bucket. And the issuances have gone up in the close to 10-year bucket and again in the very long term, which is 20-year to 50-year segment. Now, the ultra long-term segment, as well as the ultra long-term segment, is where you'll have the real money investors playing a very active role. So, for example, your insurance funds, EPFOs, etc. of the world. So they will not mind this extra bout of supply in the ultra long-term segment. As far as the 10-year segment and in the vicinity is concerned, you do have an active participation from the SBI community because we are now entering the phase where India is going to be soon included in the emerging market bond index by Bloomberg and later on by Bloomberg as well as by JP Morgan. So keeping in mind this index inclusion becoming a reality, at this time, you are seeing a bit of a lower than normal supply from the government hitting the market. And on top of that, Pallavi, I think we are also entering a phase which is likely to be seen as a phase where the global monetary policy cycle probably will take a turn on the downside. Some of the developed countries' central banks have already done it. For example, the Swiss National Bank did surprise all of us with a rate cut earlier this month. And the ECB and the Bank of England have now started sending somewhat more neutral to dovish signals. The Federal Reserve is on course as far as their March policy is concerned towards the first rate cut in June. So the mood point here is that you're entering a phase where the global monetary policy cycle could turn lower. The supply aspect is somewhat lower than the long-term average. And it is happening at a time when index-related inflows are likely to remain healthy. So net put all things together, we are looking at a probably phase where yields could drift lower.
Vivek, I have a two-part question before I can let you go. So you've touched upon a whole host of factors that's likely to influence the bond yield curve going forward. What I do want to understand is that are we then looking at greater demand than supply? Also, what is the range that you are looking at for the next few months?
Well, forecasting the demand-supply situation from a bond market perspective is always challenging. But the litmus test for us would be that if yields are going lower, that is a test that supply is getting absorbed much more comfortably. Because at the end of the day, I think the balancing factor is the RBI and the overall RBI and the other multilateral and government bodies, which also are purchasers of government securities in this context. So if yields are going lower, you can safely assume that this is what is happening. And our expectation is that maybe by the end of the financial year, we are talking about March 25 here, the 10-year benchmark yield could be as low as 6.5%. So yes, there can be a situation where supply from the government of India could be very easily absorbed by the market participants.
Okay. All right. Thank you so much, Vivek, for breaking that down so simply for us. That's all we have on the show for now, but do stay tuned to NDTV Profit. There's a lot more lined up.
Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 25 minutes, we'll try and do 2-3 things. One, of course, take queries, and some of you have written to us, so we'll try and take the queries with our experts. We will try and give you insights on 2 or 3 key things. There are some interesting fund options, as they always are, but ones which have come up new, and we'll try and talk about some of those and what's the applicability of those fund options for you as an investor. This is happening on a day when the equity markets are doing really well. So joining us on the show today to give us the right advice are Vishal Dhawan, founder and CEO of Plan Ahead Wealth Advisors, with us in our studios, and Anand Ladda, founder of Invest Arch for Kal. Vishal and Anand, both of you, thank you so much for being with us on the show today.
Such a pleasure, Neeraj.
Yeah.
Thank you.
Thank you so much.
The pleasure is entirely ours. Okay, let's start off with the first topic, there is a fund which the subscription of which just ended, but it's an open-ended scheme, and that's the Kotak Nifty AAA Bond June 2025 HTM Index Fund. Now, lest this confuse you, effectively, it's a fund which will presumably invest in fixed income, and it assumes significance to my mind simply because of the various events that are lined up. Last night, viewers, you would have heard about the borrowing plan of the government for the first half, which is not as high as people thought, and which is why yields have come off today. Then there's the JP Morgan bond inclusion event that is happening in June this year. There is a Bloomberg bond index inclusion that is happening presumably in January of 2025. And there will be presumably some rate decisions done by both the global and the local central banks. So all of this keeps the fixed income calendar very active, and possibilities of making gains in fixed income very much high. And therefore, in light of this, I would love to understand from our experts what kind of investor should invest in a fund like the Kotak Nifty AAA Bond Fund, and are there other options out there as well? Vishal, I'll start off with you. One, who should invest? What are the kind of returns that should be anticipated? And any tax implications for somebody who is in the highest tax bracket wanting to invest into this fund?
Yeah, so I think it's a great time for fixed income in general. I think for all the reasons that you mentioned, except that I think when you're a fixed income investor, you need to keep in mind 2 things. One is either you hold to maturity, which is a product of this kind from an ideal design perspective, saying, in June 2025, this product will mature. And therefore, even though it's open-ended to go in, it will probably give back your money to you unless it's extended in June 25. So I think if you're an investor who's going to hold to maturity, I think some of the interest rates going down story may not really play out too much, because you will get the return that the YTM of that fund today has, less expenses broadly. However, if you are a tactical investor who's out there trying to figure out, can I take advantage of falling interest rates? You need to keep in mind that this has only a 1 year or a little more sort of duration. Because it's got a fairly short duration, the impact of interest rate movement is going to be fairly small on the portfolio itself. So you may not see a lot of capital gains that could come in because interest rates come down. So in our mind, clearly there are 3 things investors need to keep in mind. One is, if you are a low tax rate investor, or you're someone who's very conservative holding to maturity, then this is definitely something you could consider. The rate of return you'll get is going to be whatever is the yield when you get into the fund, less expenses, give or take a little bit.
Which is
somewhere in the region of about 7.5% currently.
Pre-tax.
Pre-tax, that's right. And therefore, it's very attractive for someone who's in a tax bracket which is lower, because if you're in higher tax bracket and you end up having a 1 year sort of investment horizon, then maybe you want to look at arbitrage funds more carefully, because the advantage that you get there clearly is that you get the ability to go out and get a tax rate which is lower. Even if you hold for less than 1 year, you'll get a 15% tax rate, which is equity taxation. If you hold for more than 1 year, you'll get 10%, which is obviously much more attractive. So clearly, if you're a high tax investor having a 1 year investment horizon, then you may want to think about whether you really want to put money in here or you want to look at an arbitrage fund. But if you're a conservative low tax investor, I think this product could fit in there.
Okay, thanks for the insight. Anand, can I ask you the same question? And again, from a tax implication perspective, and otherwise just the suitability of the product, what would your thoughts be?
So basically, they are investing in a AAA rated bonds of PSUs, HFCs, NBFCs, and banks. Totally, they are this index fund is invested or giving their money out to 23 parties. It is best suitable for someone who is looking out an investment option in fixed instrument for a comparatively short-term horizon and at a low cost and a relatively safer option, because this fund is investing or giving money to the parties which are AAA rated. So it is suitable for that kind of investor. As rightly mentioned, yield presently is roughly around 7.83% and modified duration is around 1.12 years. So roughly we can expect returns in the range of 7.5 to 8% maybe in a better situation. And taxability will be just like your fixed deposit. Just like your fixed deposit get added to your income, it will be added, and whatever rate is applicable to you as an individual, at the same rate, you will have to pay taxes on the income which you earn from this fund.
Got it. So, Vishal, are there better options currently? Or are there other options which people can look at? Sure, there is this fund. People might have thought of it. But are there other options out here?
Certainly. I think there are a couple of ways to think about it. One is arbitrage, like we discussed.
Right.
If you're looking at fixed income and trying to participate in rate cuts that are happening, then I think you need to look at two categories very carefully. One is the same category, but with duration which is a little longer. So you would look at a hold to maturity fund tracking in similar index, but the index maturity would be 28, 29, 30, 31.
Why so?
For example, because if interest rates do fall, and we don't know the timing of it, but that's probably the direction that interest rates are headed in, then you will get better capital appreciation because the modified duration of this portfolio, which is 1 year or 1.1 years in this particular fund, now gets expanded. So that's one way to do it, because it's again a low expense product. It allows you the ability to participate. The other way to do this is, if you want to participate purely in government securities, go and buy a constant maturity gilt fund. They will typically run durations which are in the region of about 6.5 years. Again, low cost, no fund manager risk, just like in these funds, because essentially you're just putting money away into government securities. Duration is also fixed. So you can participate in the same way through different ideas, depending on what your view on fixed income markets may be.
Okay, got it. Well, viewers, those are some options in case you look at. And again, one, that maybe look at a higher or products which are not maturing, or the fund is not giving the money back to you in such a short span of time, but maybe the time frame is about 3 or 4 years out. Also, the benefits of indexation if you invest in fixed income funds, got to keep that in mind on other products as well as maybe this one. So that's the other aspect to keep in mind. And 3, if you're investing for a very short time frame, then maybe arbitrage funds might be better, because the tax implications, especially if you're in the higher tax bracket, might be very, very pertinent. So that's to be kept in mind. Sorry, Anand, just before we round off this piece, is there any other point that you would want to make? Because I was asking Vishal about options. Are there other options to your mind?
See, if an investor has time horizon of above 3 years, probably all season bond fund can also be an interesting space where he can look out for some opportunities, because then you will be giving your money to the fund manager and he'll be taking call of duration on your behalf. So that can be an interesting space to watch out.
Fair point. Okay, what we'll do is we'll take a very quick break right now. We'll come back, try and talk about the small cap space as well, because there are some funds out there which have stopped taking, but there are also ETFs out there which are an option. And also, as we promised, some queries which are out there, we'll try and ask our experts to give pointed responses on some of those. Welcome back to the Mutual Fund Show. It's just the perfect day to talk about high beta funds, isn't it? Because the issue came to mind because Motilal Oswal, for example, has launched a Nifty Realty ETF and a Nifty Small Cap 250 ETF. Now, typically, these are high beta indices per se. They move a lot at any point of time on the upside or the downside, and therefore, on a day when the markets are doing so well, it's great to try and figure out whether these are good indices, ETFs, to invest into or no. Anant, I would love to understand from you what kind of investors within your investor subset would you recommend a realty ETF or a small cap 250 ETF?
See, firstly, if I talk about small cap 250 ETF, I feel for an aggressive investor who is having time horizon of 7 years plus, still it makes sense. I have two interesting data points to share with you. Firstly, in recent past, obviously small caps have performed brilliantly, but at the same time, EPS growth rate have been fabulous in small cap space. In last 1 year, EPS has grown by almost 62% versus in Nifty, EPS has grown by 30%. So we can conclude that yes, in small cap space, there has been some beautiful rally which has come, but at the same time, EPS has grown. And second interesting data is in 2023, if we check out the number of down days of small cap index, number of down days was just 76. And in past 20 years data, whenever the down days is less than 85, in the coming year, we usually see more of volatility. On an average, small cap give a correction of around 22% every year. But whenever there is low number of down days in a particular year, in the subsequent year, usually the volatility or the correction even goes up to 32%. So keeping that in mind, we can get some opportunities in this year in small cap space. So doing SIP is a brilliant way for an aggressive investor to go about it. Plus, even if you get some dip, you should be ready to double up your SIP for that particular month whenever you get that opportunity. So small cap space is interesting, provided your time horizon is above 6-7 years. If we talk about reality space, that is something which I usually try and avoid for investors because that's taking a tactical call or a sectorial call. Although in past 5 years, 3 years, reality sector has outperformed Nifty. But if we talk about 15 years, reality has been underperforming. So right now, everyone is thinking that since India is growing, government is doing a huge amount of capital and capital expenditure. So obviously this sector can do well. But I would personally say for a newbie or a new investor, this can be probably avoided and can be used at a later stage when he's more matured in terms of volatility which comes in this fund.
Okay, fair point. And you can understand that as well. But for people who are willing to take a bit of risk, Vishal, real estate, typically the cycles are longer. Would a realty ETF be a good way to play that? Or you reckon people might be doing better with individual stocks instead of taking an ETF like realty ETFs? So when it comes to funds or ETFs, rather not choose this. What's your thought?
So I think the way to think about this is stocks are always forward discounting mechanisms. So clearly, I think a lot of the growth that we are seeing on real estate is getting priced into markets in advance. It always happens 6 months, 12 months in advance. And clearly, if you look at valuation data, because I think we are always slaves to valuation and earnings. I think the way we look at it is earnings look good, but valuations are one standard deviation above mean for real estate companies. And therefore, I think even for very aggressive investors, they want to be very mindful that if they're buying today, they may be buying something which is very expensive already. And therefore, what you end up doing when you buy something very expensive is you end up getting probably muted returns because a lot of that has already played out. Now, if that, even if you're aggressive, I think the question to answer is, are you better off buying something which is a little more diversified rather than just a narrow sectoral bet? So let's say, for example, you want to participate in the growth story, which will play out in different ways, not just through real estate. I think you may decide to buy a thematic fund to participate rather than just say, let me go to a real estate ETF to participate.
But real estate would be thematic as well. So what?
So I think the difference is that a broader theme versus a sectoral fund, which is what is the difference.
Like so infrastructure or cap goods
that's
or what have you.
So that has much more flexibility because what we can find is the cycles can change very quickly.
Sure.
And I think most investors, even if they are aggressive, don't necessarily have the ability to time the in and the out. So it's partly that as well, which needs to come into play.
Okay, just one quick follow-up. The small cap 250 ETF, I mean, what about that? Because small caps are the future, if you will, and if you're buying an ETF, you're buying it at a lower cost. So is that a good option, or you rather avoid it?
So again, valuations are very, very premium. And I think if you look at past data, I think one of the ways to look at this is you look at what is your rolling return over 1 to 3 years, which means on an average, how much do these funds deliver or ETFs deliver versus what they've actually delivered over the last 1 and 3 years. You'll see a very large gap. They've done much higher returns in the last 1 and 3 years over their rolling outcomes. And normally when you see this kind of data, it's time to be careful. It's time to moderate your expectations. It's time to be very mindful that maybe you're just buying something too expensive again. And unfortunately, our belief right now is that a lot of small cap investors may not end up making money for a fairly long period of time just because they're buying something so expensive. SEBI has also come out and spoken about this fraud. AMFI's come out with guidelines. I mean, all of that has also happened. So I think we should not discount that entire reality as well, which is playing out.
Okay, viewers, there you have the answer. Well, almost both the guests unequivocally talking about avoiding for different reasons, or maybe in some sense overlapping reasons, at least on the real estate ETF or a realty fund, if you will. Just be careful, know your ins and outs and the pros and cons of doing this before you go out and do this. Now, let's take some queries. There are a bunch of queries that have come in. The first one, if I'm not wrong, is from a gentleman called Rabilal. Now, Rabilal Chetri. Mr. Chetri is aged 35 years. The goal is high returns. So I think that's clear. And Anand, I'm starting off this with you. So just hear me out. Mr. Chetri is seeking high returns and is saying that he's investing 10,000 rupees per month in the SBI Energy Opportunities Fund, a direct growth option. He wants to know if it is the right fund or should he diversify the portfolio?
I feel investing complete amount in a single thematic based fund can be a bit risky. He can, if he's an aggressive investor, probably he can look at a space like small cap fund or maybe a multi-cap fund. Provided his time horizon is also more than 5 years, that can give him a more stabilized return over the longer period of time. Usually what we do is, especially when we are chasing returns, we forget about risk. But eventually, if you want to stay in this game for long term, you should even focus on risk because that will define how you will react during difficult times. You don't make money in good times. You actually make money when times are bad, but you have conviction to invest during that time. To have that conviction, you just need to ensure that you are not making a big blunder. So my take would be to go with a small cap fund. And this year, as we have already discussed, we might get some volatility, which will be more than usual. But that volatility might even bring some opportunities to top up your investment and probably aim at a better return over 5 to 7 year time horizon. So that can be a more comfortable way to go about it.
Vishal, your views?
So I think I mirror most of those views that, clearly taking a bet as on one single theme and assuming that that's going to be the best outcome in the end of 5 years is probably too risky. I think, these things can change pretty quickly. And we know that energy itself is going through so much of transition from traditional sources to renewables to geopolitics that impacts it. So I think there are so many factors at play there that even if you have return expectations that are high, you could see so much volatility that along the way you could become uncomfortable and just exit.
Okay, fair call. So, Mr. Chetri, if this is the only investment that you have, then maybe you should rethink it. If this is one of the many that you have, which we don't know of, then it's a separate argument. But right now, we've given you the answer. I believe the guests have given you the answer on the back of the belief that this is the one investment that you have, and therefore diversification might actually serve you better in risk-adjusted returns. And frankly, returns should always be viewed from a perspective of risk-adjusted returns as opposed to just plain vanilla returns. Even on that, I think the guests might differ, but here's the simple submission. Now, the second query is from Deepak. Deepak is 32 years of age. The goal is child's education. Deepak says, I'm investing in the Mirae Asset Large Cap mid-cap funds along with a few others, which we don't know the names of, but yeah, along with a few others. Deepak says that they have been underperforming for the last 2 years. Should he book profits or switch to another fund? His current SIPs also include a Kotak Emerging Equity Fund, a Nippon India Multi-Cap Fund, and SBI Contra Fund, amongst the others, like the two Mire funds. Vishal, any thoughts?
So I think very clearly, we are assuming that education at 32 for him or his child is a very, very large time horizon story, and he has enough time on his side. Now, I think it's important to distinguish performance basis a style versus a different style. So clearly over the last couple of years, value style oriented funds have actually outperformed growth style funds. And Mire, in general, has always been a growth style fund, which is why it did so spectacularly well just a few years ago, because it followed that style. And it's been true to its style, so it's continued to be that way. Obviously, what it means is during certain periods, you will outperform, in another period, you will underperform. I think for someone who's a long-term investor, I don't think you need to necessarily make changes every couple of years, because the style that you were using has now gone out of favor. We would assume it'll come back as well. I think the more important thing to think about here is with the excess premium valuations on mid-caps as well. There are two mid-cap funds clearly in that portfolio, both from Mire as well as from Kotak. The question to answer here is that, do I really have that sort of appetite? Or have I had a little bit of a recency bias that I might be chasing some past returns? And I think that's where the decision would probably be that one of those funds, maybe a Kotak Emerging, might actually go out of the portfolio. There have also been some management changes, etc., that have happened in the fund. But besides that, I think you need to pare down a little bit of mid-cap exposure in this portfolio. And clearly, as you get closer to the requirement of money, I'd say at least 3 years before you require the money, there is a need to pare down that risk even further. You need to start moving to more sort of fixed income oriented instruments, because we don't want education to be compromised. And clearly, an education goal is a very time critical goal. It's not like you can tell your child that, go to college next year because markets are down this year.
Yeah.
So I think some of that clearly needs to come into play.
Okay, fair point. Anand, does your view differ?
Sync with his view, completely in sync. Just would like to add one extra thought. See, as a mutual fund investor, we always want to do something with our portfolio. And we need to understand that not doing anything is also a decision which you are taking with your portfolio. And that's a most difficult decision to do. So at times we need to just wait and give your fund manager at least 4 to 5 years of time, and then decide whether we need to change it or we need to switch it or maybe move out and go to another fund. But at least give some time to your fund manager to perform as well.
And Deepak, that might be good advice, though you might argue that you've seen returns in the past and the last two you are not. But it's in the same vein, as Vishal was saying, at some point of time, these returns might come back. And if you've just started investing, then what Anand just said, that give your fund manager some time to invest, would hold completely true. So depending on when you've started as well, you could follow the advice. But I think the advice is in some sense very similar. So keep that in mind. Maybe no changes required to your portfolios. It's a long-term goal. Child's education. Stay the course as opposed to deviating might be a good advice. But on that note, we'll have to wrap it up because we had timed out completely on this leg of the mutual fund show. Anand Ladda, Vishal Dhawan, thank you so much, both of you, for taking the time out and being with us. And viewers, thanks for tuning into this leg of the mutual fund show.
Hello and welcome. This is Last Trades. I am Agam Vakil, and in this show we take you through all the stocks which are buzzing in trade on account of bulky block deals and, well, volume buzzers. But first, I'll take a look at the markets, which are looking very, very strong at the moment. The Nifty is trading near its day's high, and as we speak, it's looking at a sharp uptick, up around 1.4% on the final trading day of this financial year. At the moment, this is how things stand, and there's no letting up. And, well, at least as far as those which are constituents of the Nifty, which are advancing in trade and helping the Nifty, forge forward, it is essentially the banking sector. We have a lot of buying coming on, along with the names of ICICI Bank and HDFC Bank, which is in fact pushing the Nifty higher by around 300 points. Then there is in fact no loser at the moment. We also have seen gains in likes of Bajaj Finance and Bajaj Finserv, which are also of course a part of the Nifty, but there's been a lot of buying coming through there as well. And let's move on and talk about a handful of other broader markets too, and see how things are faring there. Well, the broader markets are underperforming. That we have seen gains there, but not to the tune of the gains that we've seen in the benchmark. So I reckon a lot of institutional activity, specifically in the large cap names, has been coming through. The small cap index is also up and about for now, but buying essentially has been in the 50 top companies by market cap and free float. But well, moving on, even in terms of the broader markets, we do have, a handful of these names which are doing well in trade. Of course, we have the likes of something like a BSC that's up and about by around 2%, 2.9%. We have a relatively smaller name like Sangri Movers, which is up around 4.4%. We have something like a Kalyan Jewelers, which has, of course, been on the radar of the brokerages of late. That's up around 3%. And Action Construction, that's the other one, which is also advancing by around 2% as we speak. We have, not too much in terms of losers in today's day of trade, and it's very evident the kind of, traction that we've seen. That said, we do have some amount of marginal pressure in, a handful of stocks here and there. Let's pull out the advanced decline ratio as well and see how things are panning out there in the broader markets. And there you have it. That's, certainly more advances as compared to declines, nearly to the ratio of 2:1. Again, it's going to be an interesting day, specifically because it's also, the expiry for the weekly as well as the monthly options, and of course the monthly futures as well is where we're going to see a lot more traction. As we move into the final 1.5 hour of trade as well, where we could likely see some amount of choppiness, but for now there is no relenting in the kind of buying that we've already seen through the course of the day. And let's not forget, the last half an hour could in fact see some accelerated institutional buying as well. That is something that we're going to anticipate. Let's keep an eye on that one as well. But from there on, let's move on and talk about all the stocks that we want to address in this show today. So we are going to talk about VIP Industries. We're addressing IDFC First Bank, where we also have some bulk coming through. Aegis Logistics is one of the top movers in terms of the stock today, and of course Chalet Hotels is the other one which is also in focus. But we start off with VIP Industries right at the top. Let's get in Mahima to give us an idea on what's really going on. Remember, VIP is turning a corner of sorts, but let Mahima take this over.
Right, Agam. So the VIP stock has made a comeback after a sharp dip. VIP Industries stock is coming off its 3-year low now, and it did touch an intraday high of around 14.7%. The volumes are around 23 times its 30-day average, and support levels are around at 481.95 a piece, and resistance levels around 667.8 a piece. Now, this is because the analyst meet for VIP Industries recently took place, and the key takeaways from this were that VIP is launching its products in the premium segment across brands. It's eyeing a revenue CAGR anywhere between 15 to 20%, and they said that they'll come back to margins of 14 to 15%. They've also said that margins will improve because of supply chain efficiency and operational efficiency overall. And they also mentioned in their investor meet that they are mindful of the market share loss that has taken place. They've come down to 37% from 48% market share, but they've given the turnaround strategy strategy, and they're looking for 14 top cities new EBOs, and the management has noted that focus for back end was clearly a not good strategy for them, so they'll focus on the front end part. There was a Nuama note on VIP Industries which came out. They've said that it maintains hold with a target price of 517, and it values the stock at around 30 times its FY26 estimates PE, and it's fixing the supply chain right now, and that will be the key leverage to watch out for. And lastly, the street view for VIP Industries, where in terms of analyst recommendations, 7 say buy, 5 say hold, and 2 say sell. So this is the overall view of VIP Industries and what is happening in VIP Industries.
Okay, well, thank you so much, Mahima, for joining us and giving us that take on VIP Industries. And as Mahima has already mentioned, it's coming off lows in a multi-year low. The question really is that if this is big buying coming through, can we see a further upside from current market levels? Of course, volumes are certainly supporting some sort of a further upside from current market regions. But the question really is that if there is more strength to this counter. That said, let's move on to the next one, and we have IDFC First Bank also in focus. Well, let's get in Puneet to tell us a little more about this one. Puneet.
Yeah, thank you, Agam. And now the volumes on IDFC First today are up 4.5 times its 30-day average. Well, the stock has also hit an intraday low of roughly 3.5–4%. Now, this is on back of a huge block deal that happened this morning of roughly 2.6% of equity that changed hands in IDFC First. Now, roughly around 1.6 million shares traded on the bourses today. Now, we still await the details of sellers, which will be available by the end of the day. But the likely seller in this particular transaction is Warburg Pincus affiliate, which is Cloverdale Investments. Now, do note that they held a lot of stake in the past few years, and they have been pairing this stake. So currently, in this particular transaction, they raised roughly 1,200 crores from this stake sale. This was at a floor price of roughly 75 rupees per share, which was 3 to 4% discount from its current market price. Finally, they will not own any stake going forward. And previously, in the month of December 2023, they did pair their stake by 1% and raised roughly 790 crores. And also a big stake sale happened in this particular counter in September, where they sold 4% stake for roughly 2,500 crores. Finally, on the stock performance, the stock has done really well in the past year and is up roughly 43%. Back to you.
Puneet, thanks so much for getting us those details on IDFC First as well. And then let's talk about Aegis Logistics, which is also in focus on the back of volumes and a surge in price. We have Varsha who's joining us to give us an update on the same. Varsha.
Well, thanks Agam for that. If you see, the volume for Aegis Logistics is over 9x, and company has seen an intraday high of almost 13% in trade today. Now, if you see, let's look at the background of this company, what this company does. So this company is engaged in providing logistics solutions for oil and gas and chemical and petrochemical industries. Also, they operate network of bulk liquid handling terminal, the liquefied petroleum gas terminals. Also, they have filling plants, pipelines and gas stations to deliver product and services. The liquid division contributes almost 30% to the revenue, while gas division contributes 70%. Now, if you see the future outlook for this company, the crux for this company is they're doing CAPEX, which is the largest CAPEX implementation in Aegis history. Now, they're undertaking 1,700 crore CAPEX on its logistics storing services for its chemical and petroleum product vertical. Now, this will be completed in next 18 to 20 months. They're expanding their services to include the storage of green ammonia, for which they're constructing 80,000 metric tons per annum capacity in Odisha. Now, green ammonia is a derivative of green hydrogen, which will be produced under NGHM, and this will be specially for fertilizer industries, wherein currently all the fertilizer companies are importing this ammonia through LPG, and this is leading to higher production cost. Also, this company has completed Aegis Vopak joint venture to take advantage of numerous growth opportunities in the field of oil, gas and chemical logistics in India. Lastly, if you see, the company has maintained its guidance of achieving a growth of 20 to 25% compared to previous year, and they expect 15 to 20% of EBITDA generation on 4,500 crore capex investment over FY22 to 27. So this is all we have on Aegis Logistics.
Okay, thank you, Varsha, for getting us that deeper take on Aegis Logistics. This one also up around 11%, and it's one to keep an eye on. And from there on, we move on to talk about Chalet Hotels, which is also in focus, even as it looks to raise funds. Let's get in Anushi to tell us a little more about this one. Anushi.
Hi, so if we are to look at Chalet Hotels, now it is seeking to raise up to about 2,000 crore of funds via the QIP route. Now, do note over here, while it is seeking to raise about 2,000 crore, in the terms, it is expected that they are going to be raising up to about 1,200 crore. That is the expectation drawn. So we have to look out for more updates on the same. Now, if you have to consider the floor price for the same, that stands at about 780.76, which is about 10.4% of discount compared to yesterday's closing price. Now, a couple of reasons that the company had cited out in their previous conference call on why they are proposing this fundraise. One is the paring down of the debt position. So if we have to look at the current debt position, that stands at about 2,400 crore. Again, then they have notified that for the fundraise, the intention is not to go completely debt-free, but to retire some part of their debt. Also, they are also looking for more opportunities for expansion or further in the coming years, future ahead. So that has also been set aside for the fundraise. The capex plans, though, remain completely funded through most of the internal accruals. Now, if you have to look at the stock performance for today, that saw about a intraday high of about almost 10% in today's session, which has now come down. And if you have to look at the volumes, that traded at about 5 times its 30-day average. Onto the analyst recommendation for the stock. So 11 have a buy rating, while 1 have a hold rating and 1 have a sell rating. But the potential upside or downside, if you have to look at that, comes to about 6.8% of downside. Onto the stock performance that the company has had in this 1 year itself is quite phenomenal, about like 147% of return in just 1 year. While if you have to look at the 1 month and 6 month return, that stands at about 8.5% and 62% respectively. So this is all that is building on Chalet Hotels today.
Right, Anushi, thanks so much for getting us that update on Chalet Hotels, another one to keep an eye on. And on that note, we slip into a short break, but on the other side, we get you a lot more in terms of stocks. Stay tuned to NDTV Profit. Welcome back to Last Trades. Well, we move on to and talk about the Bajaj FinTwins, which are, of course, doing phenomenally well in today's day of trade and finally starting to see some traction on the upside. Well, we have Bajaj Housing Finance, which is preparing for an IPO worth $1 billion. Let's go across to my colleague Pragati Oberoi for more details here. Pragati.
Bajaj Housing Finance is planning an IPO worth $1 billion. That's what sources are telling us. Now, we must remember that Bajaj Housing Finance is the wholly owned subsidiary of the company Bajaj Finance. Now, what we are gathering from our sources is that the conversations are still in early stages and only the planning has as of now started because nothing has been finalized and the entire process is expected to kick off in about 2 to 3 weeks. The valuation is expected around $10 billion and the IPO size is expected around $1 billion. That's how the calculations are flowing. Once again, these are the expected numbers and where the conversations are headed. What the final amount comes out will obviously be known once the planning or the process kicks off. We also know that based on the process or where the step is at, the listing of this company is expected around the end of 2024 or early 2025. Now, we must remember that Bajaj Housing Finance's listing or the IPO is very important because the company needs to comply with RBI's scale-based regulations, which need the company to be up on the exchanges by October 2025. That's the deadline that they have. So before that, the company is planning this IPO. We'll bring you more details as and when we have them.
We most certainly will be keeping an eye on Bajaj FinServ as well as Bajaj Finance with that IPO coming through. But, at least as far as the markets are concerned, just take a look at the Nifty. It's currently at its day's high and it's actually less than 100 points away from its life high. Is there a possibility that the Nifty could in fact take out its life high in the final trading day of this financial year? That's a wait and watch on that one. But we are looking at this one moving from strength to strength. In fact, it is edging towards 22,500 as we speak. And it's looking less and less improbable that that particular level could be achieved today. Nifty has already gained about 350 odd points, and as I've been mentioning, some time ago as well, we're likely to see a lot more institutional activity in the last 1 hour of trade, and we're approaching that mark already. So, there's no saying as to where this index can in fact eventually land up, and I am sure that literally no one is going to bet on a substantial come off as far as this index is concerned. That is an improbable event, possible but improbable, and of course we continue to see gains coming through at the moment. Even in terms of the banking index, and let's pull that up as well, because a lot of the strength is on account of the banks, because we do finally see strength in HDFC Bank and ICICI Bank providing that impetus. But even if you leave these two banks aside, we have some of your relatively, of course, relatively smaller counters, which are also providing a lot of strength. So, in fact, if you just look at the pharma sector, we have something like Dr. Reddy's or Power Grid also up and about and advancing in trade. And that's largely what we have in terms of how things could pan out for the index. But we move on to the QIP boost for Wockhardt. The stock has advanced today, and we spoke to the founder and chairman of the company, Habil Khurakiwala, about the allocation of the QIP of over 480 odd crores. Here's what he had to say. Listen in.
We primarily have 2 or 3 areas where we need funds, and that's why we did this QIP. One, obviously, is a new drug development of 5222. And we want to complete this phase 3 clinical trial in time. And that is where part of the money will be utilized. The other one, obviously, is to build up our business portfolio of launching these 2 new products in India, Fitromycin during this year and early next year. 5222. Both these would require initial investment in developing business. And that is what we intend to do, and that is where we will have a very significant penetration strategy, which we have worked it out on that. The second area is obviously a need for normalizing our business and some other corporate purpose, basically.
Sir, let's take this one at a time. And a couple of areas I want to cover with you. WCK 5222 and WCK 4873 are the big bets for you and for the company. Can you explain to me, these two products, of course, are going to require a lot more money. They're both in phase 3, I believe. Part of the fundraise will be, of course, go towards those products. But is this, can we expect more fundraising? Is this part of a bigger fundraising plan for Wockhardt?
No, I think this is initially we have raised this equity from what we need for next 12 months or so, 12 to 18 months. And we hope the business will normalize and generate cash flow for our future needs. If, however, we need future funding, we will obviously look at various options of equity or debt at that point in time.
Right. Well, BSE has released a list of 25 companies that will switch to T+0 rolling settlement cycle. The cycle will be live from today. My colleague Saloni Kothari is joining us with more details about this new cycle. Saloni, over to you.
T+0 settlement is going to be a reality from today, but mind you that it's going to be on an optional basis, as the beta version of the launch will be starting from today, which includes 25 stocks at the initial stage with limited set of brokers, and SEBI will review the progress at the end of 3 to 6 months to take the next course of action. Now, before we get into the list of the stocks included, let's understand what T+0 actually is. It aims to settle trade on the same day instead of T+1, where the settlement happens the next day. The seller of the stocks will receive money on the same day when you sell the stock. Now, the stocks that are included as per BSE and NSE includes Bajaj Auto, Ambuja Cements, Ashok Leyland, SBI, Tata Communications, Vedanta, among others. Talking about the market timing, it's going to be on a continuous version of 9:15 a.m. till 1:30 p.m. And who and all are eligible? Right now, all members and investors are eligible to trade, but again, it's on an optional basis and not a mandate. And the proposal is to do it in a phase manner, which is phase 1 and phase 2, which we will get to know only after the review is done by the market regulator.
And we spoke to Helios Capital's Samir Arora, who shared his rather grim view on India's IT sector. Listen into a slice of this conversation.
I have been zero weight since 2022 July and underweight since Jan 22. And all my life before that, I have been overweight IT and even ran a big IT fund, even in India, one in Asia. So I don't know whether it is dead or not, but it is not doing well. And the issues are more than just, what happened this month and that month kind of thing. It is a serious issue. But broadly, I always believed that the Indian IT companies do not properly guide. And I saw that many times in my life. So I don't listen to them or ask them what it is. I draw my conclusions from the big picture in this case. And the big picture is against IT. And so there are many reasons for that. First is that these Indian IT guys are not hiring themselves. They are not even having the decency to honor on-campus recruitment. I mean, how much more signal do you want that they don't see the potential? Second is, we broadly know that AI, which is getting a lot of investment, what is the true objective of AI? One could be that you are doing things which human beings could not do. Let us say some drug discovery, some new metal discovery for which the accelerated computing is required and AI is required, God knows what is required. But the second is to replace jobs, and the replacement jobs, and to bring things onshore and near shore, and a fight between different countries and hacking and everything means that one purpose of that AI is to replace jobs, and those jobs that you replace are of people who use computers. It is very difficult, although that is also being tried by doing, say, autonomous driving, that you are trying to replace jobs of people who didn't use a computer. But at the first level, it will be that a computer can replace a job of a person using a computer. And big picture, it has to shrink. And so don't tell me that we have got these cost reduction orders, which have a very different margin profile, very big projects they are announced, but that is you can multiply an order by 15 years and call it a 1 billion order, or if you multiply by 5 years, it will be a 500 million order. And then you can always have in that an option for that company to break it after 7 years. That they are not going to tell us. All you have to do is if you get a $50 million a year order, you say it's a 1 billion order because it's for 20 years. But between you and the company, there is an exit after 8 years. They are not telling us all that. And I don't believe in cost-cutting orders being immediately good. They might be good one day in the end when you cut the costs and you have, moved those guys offshore or whatever you've done with them. But big picture, I don't like it. But the second reason is other sectors are doing well and I have $100. So why should I bother? If nothing else was doing well, I'll be forced to say, is it discounted? Is it not discounted? Has it fallen too much? Now I say, why? First, I should have a reason. And the stocks haven't done so badly. They did badly in my first year of not having them. In the second year, they have done actually well. So they have not hurt me only because some other stocks also did well. Like the Zomato, then HPCL, or whatever worked for me. So that same money, why am I banging my head in a complicated situation since many other stocks are doing well and the amount is the same? You put it here or you put it there. So unless it really pains me, I don't need to go to the stage of analyzing, is it discounted, is it not discounted, will the third quarter be better? Because the stocks haven't done badly actually. It's not that I have hugely gained relative to an index, but I don't like it right now. That is just the way it is.
Well, with that, it's an end to this edition of Large Trades, but don't go anywhere. Lots more lined up on the other side. Stay tuned to NDTV Profit.
Thanks for tuning in to India Market Close, and I don't think we could have opted for a better script to end the financial year. From a bull's perspective, of course, 1.63% higher, a trending day. The intraday chart will show you how beautifully the market has inched up during the course of the day and currently trading at the peak. Look at this. This is a beautiful way to show the 358 point uptick. We started off okay and are currently trading at the high point of the day. Similarly, for the broader end of the spectrum, at least the mid caps have not done too badly. 0.77% higher, in and around the highest point. And one of the reasons why the small caps underperforming the large caps today, by the way, 0.6% higher. So leave that out. But one of the reasons why this could be happening, and bring up the heat map for the Nifty, and you will see that heavyweights are participating today. Just two losers. That's the one amazing thing. And the gainers have some very strong names out there. Broad participation from an autos to insurance to NBFCs, but look at the financial space participating today. It's a day for financials, viewers. There is SBI up 3%. There is Bajaj Finance and Bajaj Finserv up about 5% apiece. Non-financials, of course, Power Grid, Adani Enterprises, etc. But just the way banks and PSU banks and NBFCs have performed is the beautiful thing. At some point of time, we'll get in Vishwanath, my colleague, and try and talk about this in detail. We'll get in Rajesh Palavia and talk about technicals as well. But bring up the PSU index gainers today, and just the kind of moves that we've seen in the PSU bank space. This is a perfect depiction. Look at the gains. The 8th most gaining bank, which is Canara Bank, is up nearly 4%. BOI, Bank of Maharashtra, IOB, UCO Bank, everything in the PSU bank has done well. And one of the key reasons why you could attribute this to is what the yields have done today. By virtue of the borrowing program that was released yesterday by the Government of India, for the first half of the fiscal, yields have come off. I think this is a bit delayed. We're probably close to 7.0096. So let's change this. Ignore this yield number. But the point being, because yields have come off, you have a stellar run on the PSU banks in the session today. Lastly, let's just show the BSE 500 gainers and losers before I go to our guest and try and ask. But look at the kind of gains that have come in. For an Aegis Logistics, 12%. Latent View, 11%. VIP, 15.5%. I mean, the gains are very, very strong and palpable. And it's not just banks, by the way. It's some of the other stocks as well. Sure, there are losers, as there always would be. So there is some bit of a pullback that Torrent Power is seeing after a seriously strong run. IIFL might have started off okay, but IIFL and JM Financial, both of them are down today. Remember, they were up about 9% in trade yesterday. So they've come off too in the session today. So that's the other part of the puzzle. But doesn't take away the fact that it's a day of financials. Now, our guests should be with us any moment, and we'll go to them as well. Just the last small piece that I want to highlight in the session today is what's happening to NBFCs individually. So if we can pull up the intraday of Piramal Enterprises on the screen and just show you what's happening at that stock, because that's just symptomatic of the kind of moves that could have happened in NBFCs too. It's not really big bang, but it's about 1.5%, and that therefore there is some strength that we're seeing in specific NBFCs as well. But Rajesh Palavia joins in right now with his thoughts on the markets. And Rajesh, what a superbly fine trending day that we have from a bull's perspective. Good afternoon. Do you think this sets the momentum for some more upsides come next week?
Good afternoon, Neeraj. A very stellar rally in the market on the last day of financial year, as well as the series last day. No one has predicted this kind of move on the especially on the last day of March series. But the kind of momentum which we have picked up after crossing 22,200, that was the major call concentration area. And in the gap up opening, once we able to sustain above those level, then this really extended due to short covering. And now almost we are heading towards the all-time high trajectory also. So looking at the overall broad-based buying action in large cap as well as in the mid cap space, that clearly shows that this momentum can extend further, and possibly on the very first day of April, we are going to have a new all-time high trajectory for Nifty, and possibly this really can extend to 22,700, 22,800 level also. As most of the call writers have covered their position, now they are shifting on a higher side. So 22,700 is the next level where Nifty can, continue its upward momentum. On the Bank Nifty also, we are now able to, take out 47,200. That was the major, supply zone based on the call concentration. And looking at the momentum in most of the PSU bank as well as in the private bank, we believe that, Bank Nifty, even the financials are also showing good traction. So that clearly shows that, BFSI is also now started participating in this move. And we could see next level for Bank Nifty towards 47,800 to 48,000 level in the continuation of this uptrend. So both indices are looking bullish. Buy on dip should be your strategy. For Nifty, your stop loss now should be placed at 22,300 to hold long. For Bank Nifty, your stop loss should be at around 47,000 to hold long positions.
What about specific stocks, Rajesh?
Yeah, so first stock that we like is from metal space, and Vedanta is looking promising, looking at the rollover action and the kind of chart structure which we are observing on the daily as well as on the weekly time frame. That clearly shows that, now this stock is ready to start, upward momentum. So for next couple of trading session, one can look to buy this Vedanta for upside target of 285. Stop loss should be at around 269. Second stock is from automobile, that is Tata Motor. Again, since last 3-4 trading session, stock is showing buying interest. Towards the expiry, stock is now approaching to its highest point for this March series. Looking at overall structure, we believe that Tata Motor has potential to regain to its all-time high trajectory again soon. So Tata Motor is buy for upside target of 1,040. Keep stop loss of 980. And the third stock is Grasim. Stock is now at all-time high level. And looking at the overall structure for the stock, we believe that this stock can continue further more upside. So Grasim can be a buy for upside target of 2350. Keep stop loss of 2260.
Okay. Well, Rajesh mentioned financials, and I mean, no surprise really. Those are the ones that have done extremely well. And Vishy, my colleague Vishwanath Nair, of course, joins in on the show as well. And just a confluence of so many things that could have led to this. But what stood out for you?
Well, clearly the borrowing calendar was a big one. I was listening to Jayesh Mehta speaking to you in the morning. What he pointed out was that this was a big positive surprise. The government borrowing less than what was originally anticipated, close to about 1 lakh crore less in the first half of the next financial year. That proves that there's that bit of positive spin on the bond side. Obviously, that also has implications on liquidity. What that points out is that the government is not going to suck out too much liquidity from the system because the system is already grappling with a lack of liquidity. So how banks will manage, of course, will depend on individual banks, but it seems that going ahead, the financial sector should have a bit of an easier time to tap the market for immediate liquidity. That's a big positive. Financials all looking strong. Of course, the RBI last evening came out with a special set of clarifications saying that the AIF guidelines which they announced in December, now they will apply with slightly less force. Banks can write back some provisions, so that's going to be a boost for Q4. Yeah, as you said, confluence of factors, everything playing in at the same time, for sure.
Yeah, Vishy, just one quick thought on this as well. We've been, or rather, a lot of market sectors have been, impacted in a negative way because of regulatory action. Towards the end of the year, the first move, which is kind of slightly positive from a regulatory action from the Reserve Bank of India, and the borrowing calendar pointing towards what the yields are suggesting. Yeah. Now, it was a no-brainer that PSU banks would do well. Are people that you're talking to talking about the loan growth numbers for some of the PSU banking stocks or banking at large being reasonably strong enough, or are there doubts around that?
No. So at this point in time, at least with regard to the public sector banking system, there is still hope that at least for the next couple of quarters, things are going to look better than stable. That will likely sort of peter out over the course of the year, simply because base effect starts playing in. Over the last financial year, we've seen really high credit growth. So that once that comes in, once that kicks in, then the base effect starts showing up in the second, third, fourth quarter. Things will start to look a little bit more normal. Having said that, private banks, by virtue of having a very high credit to deposit ratio, themselves will have to slow down on the credit there as well. So your big guns like HDFC Bank, ICICI, not ICICI so much, but HDFC, Axis, IDFC First, Kotak, all of these are big players in the credit market. All of them will have to at least slightly bring down their credit growth. So comparatively, public sector banks start looking better because they do not have that kind of baggage on their books. They have, all of them, most of them have deposits quite in excess of where their loan books are. So things will look better from a comparative point of view. Whether it's enough for the market to rejoice, that's something that I'll leave it to you to decide for that.
No, but fair point. Okay, Vishy, thanks for giving us that perspective as well. And as Vishwanath said, a confluence of factors really working beautifully for financials today. Rajesh mentioned that too. Rajesh, while we've spoken about banks at large, just one quick word on the PSU banks specifically. How good are the derivative positions or the charts? Look, I mean, as we are wrapping up this series and this year, how do the charts and the derivative positions set us up for PSU banks in particular come April?
Definitely. So clear picture would come post rollover from the derivative perspective. But looking at the technical perspective, yes, SBI, Canara Bank, these two banks are looking promising from large PSU bank, and we believe that the kind of setup which we are observing on Canara Bank, and the stock is now holding about 20-day moving average. The way stock has recovered from its 50-day moving average, that clearly shows that now stock has potential to continue furthermore upside towards 620, 630 could be the possible target in the near term to short term basis for Canara Bank. So this stock is looking very promising, and one can buy and accumulate Canara Bank and keep stop loss of 555. Another bank, that is SBI. Though there is still, momentum is still not there in SBI in terms of price action, but looking at the overall longer term time frame, stock is bullish and holding the ground at a higher level. The way stock has recovered in today's session, that clearly shows that now short covering is taking place. Once stock crosses above 765, 768 kind of zone, then possibly this short covering can extend. And then we can see SBI to move further higher towards 790 to 810 kind of level on the higher side. So I think most of the PSU banks have corrected in last couple of weeks, and now taken the support from their important support area of 50-day or 20-day moving average, now showing the recovery. So I think the same kind of behavior across the PSU bank, and we believe that SBI and Canara Bank are looking attractive from large PSU bank. And if we go on the smaller PSU bank, so I think Bank of India, that stock is looking very promising. The way stock is holding the long-term breakout on a monthly chart, that clearly shows that Bank of India can again start railing. And once stock crosses above 140 kind of level, then possible really we can see towards 155 to 160 for Bank of India. So that stock is also looking promising after this corrective move. One can buy this stock with stop loss of 133.
Okay, Rajesh, Sion, so much more to talk about. We'll take a quick break. We'll try and get you a global perspective on all that's happened across the world and India as well on the other side of this very quick break. Stay tuned. back with India market close right here on NDTV Profit. Indian markets are done well. S&P 500 has notched in a stellar 10% up move for the quarter as well. I mean, unless something really dramatic happens today. So equity markets per se are doing very well. Jonathan Schizell, Deputy CIO of Westminster Asset Management, joins us right now on the show with his thoughts on all that's happening around. Jonathan, great having you. Good morning to you. Thanks for joining in. What do you make of this uptick that select equity markets, there is US, there is South Korea, there is Japan, and there is India, are having currently?
Yeah, good morning. Yeah, look, it's obviously there is, a lot of people always think we're coming into the end of the first quarter. There might be a little bit of window dressing going on, but clearly we have a number of markets that are at or hitting new all-time highs, equity markets, that is. So, clearly markets are still in a bullish mode, and it wasn't, I think we have to not forget it wasn't that long ago where I think most economists were predicting the US would fall into a recession and people were concerned about equities. And I think a lot of people sold down equities. And I think what we're seeing now is a bit of a reversal of that. And people are trying to sort of up their equity weights as they think the chances of a recession clearly have lessened somewhat.
Jonathan, the US markets, because of what's happening to the tech stocks, is doing well. You can argue that some bit of it is playing out in South Korea as well. What about markets like Japan, which have shown such a steady rally? There is a bit of a policy normalization that is starting to happen, if you will. Are there more upsides for some of those Asian markets?
Yeah, I think you're right. I think Japan has some very specific factors at play. I mean, you've got the Nikkei in Japan, which has a slightly higher tech weighting, so a bit like more, a bit more like the Nasdaq versus the S&P. You've got the Nikkei with a higher tech weighting. You've got a number of tech stocks which have driven that market higher, and then you have the Topix index, which is a broader index like the S&P in the US. And the Topix index is a bit more domestically focused, a lot more financials, and those financials have been seen to be a beneficiary of rising interest rates in Japan, and so they've done very well as well. I think India and Japan have a number of similarities. Both those markets, you have actually seen quite a broad-based rally, so breadth has been pretty good. Yes, there's sell-offs from time to time, but I think India and Japan have seen good breadth, which was something we've missed, particularly in US markets, as you rightly point out, which has been led by relatively few very large tech stocks. But I think overall, Asian markets still look pretty good value when we compare them certainly to the US markets.
Okay. And Jonathan, and therefore by that breadth, India, I mean, it's an end of a financial year for us. We kind of follow the April to March calendar. And we are ending this financial year on a very high note. The markets have done really well today. What's your sense? I mean, forever the talk about higher valuations, but we're entering another earnings season as well and the election season. How comfortable, uncomfortable are you with positions in India, valuations in India, and more?
Yeah, look, I think, the reality is, I've been investing in India for many, many decades. And if I'd listened to most of the people worrying about valuations, I would never have entered that market in the first place. I think we all know India trades so-called expensively compared to other emerging markets and most other markets, but yet the fact is performed extraordinarily well over time. And ultimately that's down to the plethora of very good compounding type growth companies that India offers investors across multiple sectors. And I think, India, the reality is markets don't fall because of high valuations. You need a separate catalyst, and then, high valuations can come back to bite you later on. But traditionally, markets haven't started selling off just because of valuations alone. It's needed some other catalyst. And I think clearly, certainly from a foreign investor perspective, I think expectations are that Prime Minister Modi will get his next term, and therefore we'll see more of the same, and therefore, Indian equity markets can still, move higher. Clearly also, just not to drag this point here, but clearly also we have another factor at play, which is China. And, with Chinese markets still looking difficult, a lot of investors still not interested in that market, what that does is focus more attention on the likes of India. So I think, and then that factor is unlikely to sort of dissipate in the near term. So I think that's also supportive of Indian equities.
I think that's a very good point because Chinese markets have erased the momentum that they had probably started to build as well. Jonathan, just one last question before we thank you. I mean, because you've been invested in India for so many years, and we've been talking for so many years as well, what is the current set of favorites, if you will, in terms of themes? Because the clutch of themes out there in India right now, which different people are liking in a different fashion.
Yeah, I mean, the reality is as we all know, foreign investors play in a fairly small pool. They tend to stick to the larger stuff. And actually, when you look at global funds, they might only have a couple of positions, if at all, in India. And I think, one of the best ways of playing India remains financials. You were just highlighting financials before I came on air. Indian banks, that clearly private sector banks in particular, gives you access to a broad number of sectors through buying a financial. And it plays into a lot of the growth story that India can offer investors. So we continue to like Indian financials as one area. And obviously other areas would include the CapEx side, the capital expenditure beneficiaries as well. But broadly speaking, probably, foreign investors do, if they'll own anything in India, they'll probably own one of the private banks.
Fair call. And Jonathan, appreciate that. Appreciate that thought. And thanks so much for taking the time out and speaking to us today on NDTV Profit.
Thank you.
Well, that's the view from Jonathan Shizel. And, that statement was very nice that he's been investing in India for so many years. If he had heard people all through the years talk about how expensive India was, and India has traditionally remained expensive, he may not have made the money that he would have made by investing in India. I think it's a telling statement of sorts. So that's the FI view too out there on a day when the markets have done so well. Now, before we go back to Rajesh, let me get in my colleague Varsha, who joins in on a buzzing day to talk about some of the key stocks that are buzzing, but are buzzing on the back of high volumes. Varsha, good afternoon.
Good afternoon, Neeraj. So yeah, few of the stocks that are buzzing as of today is starting with VIP Industries, wherein stocks on intraday high of 14%. Now there's a note on VIP Industries by Nuvama, which has maintained hold with a target price of 517. Now the key highlights of this note are VIP is launching products to move towards the premium category, and they are eyeing a revenue CAGR of 15 to 20% for the next 3 to 5 years, and margins are likely to improve to 14 to 15%. Then we have Century Textiles and Industries, where stocks are an intraday high of 12%. Now this stock is up for second consecutive session. Yesterday also the stock rose almost 4%. Then we have Aegis Logistics, wherein volumes, if you see, are over 9x. It's 30-day average, and a stock did see intraday high of 13%. If one has to look at the future outlook for this company, they're doing a capex of 1,700 crores on their logistics and storing services for its chemical and petrochemical products. Also, they've maintained their guidance of growth of 20 to 25% for FY24, and they expect 15 to 20% of EBITDA generation on 4,500 crore of capex over FY22 and 27. Lastly, we have Dilip Bilcon, wherein there is an expectation that there will be hike in toll charges for Bangalore-Mysore highway between 3 to 14%. This may be the reason that stock is up almost 10%. Although on 18th March, company received orders worth rupees 413 crore. It's a JV contract from Madhya Pradesh for irrigation project. But do note that this needs to be completed in next 4 years. So these are all the buzzing stocks as of now.
Okay, thanks a lot for that. And Rajesh, can I take it to you? 3 or 4 of these names, Century Textiles, VIP, how do they look on the charts?
So first I'll take on Century Textile, and as a disclaimer, this stock we have already recommended to our client in morning itself, and our targets are 1750 to 1800 on a positional perspective for Century Textile. The way stock managed to give breakout on weekly chart, a contracting triangle breakout is happened on the weekly chart. That breakout is clearly indicating that now if stocks holds above 1560, then possible upside target we could see towards 1700 to 1750 in the continuation of this up move. So I think Century Textile one can hold on, and I think if you get any dip, minor dip, can be used as a opportunity to again add the stock. Again, if we talk about the VIP, yes, very strong buying interest in today's session, though stock was in downtrend. And looking at the short to medium term structure, still stock is trading below to their important moving averages. But the kind of momentum which we are seeing in today's session, stock has now comfortably holding about to 500, 510 level. So that level needs to keep as a stop loss. 510 should be your stop loss to hold the position. And looking at the near term structure, we believe that this further follow-up buying action we can see in the coming session, and 550, 560 could be the immediate target for VIP industry. DBL, yes, there is again momentum is taking place. Stock is now approaching to its multiple supply zone area. After a long consolidation, I think if its stocks manages to cross above 560, 465, then possible extended rally we can see towards 480, 490 also for Dilip Buildcon. So I think these three stocks are looking promising. Our preferred choice would be Century Textile, then Dilip Buildcon.
Okay. So Century Textiles is amongst the top calls that have been given by Rajesh to their clients already. One call that might have been difficult to take because the stock started on 19% higher, though did dip intraday, but is now locked again on a 20% circuit, is GOCL Corporation. Like I said, upper circuit today on the back of an asset sale. My colleague Anushi joins in to put the news into perspective. Anushi, good afternoon.
Afternoon, Neeraj. So now if you have to look at GOCL Corporation, quite a field day it has had over a 20% gain as of today. Now this is on the back of the news of its land monetization in Hyderabad, which pertains to its signing an MOU with Squarespace Infracity Private Limited. This land monetization pertains to about 264 acres of land situated at Hyderabad, and the consideration for the same is estimated at about 3,400 crore. Now, if you have to take this in context with the company's market cap, that stands at about 2,200 crore, quite a significant sort of land monetization size that we are looking at. Again, this monetization period for the same is in the range of 18 months. So over here, with the signing of this MOU, the company is to receive about 520 crore as of the signing date. Now what's happened today is, if you have to look at the volumes as well for the company, that is about 30 times its 20-day average, and the stock performance as seen about 20% today. But if you have to look at the backside also over certain periods, 1 month the stock did see about a 7.4% downside, while in the 6 months it has clocked in about 8% gains, and in 1 year about a 59% of a return over the time. So this is all that has been building on GOCL Corporation as of today.
Okay, Anushi, thanks so much for putting that into perspective. That stock is up 20%, but the markets have done so well. It's just a special time to get in a really special guest for a very quick perspective. Mihir Vora of Trust Mutual Fund joins us right now on the show. Mihir, thank you for accepting to talk to us. I know it was very last minute, but really appreciate. It's just the kind of a move that has happened on the last day of the financial year that prompts us to do this. How constructive or not constructive are you, Mihir, into the next couple of quarters, considering that we are ending the year on a high, but we are also entering a very, very busy calendar over the next 2 or 3 months?
Hi, good afternoon, Neeraj. Always a pleasure.
Thank you.
I am traveling and on the road, but the markets are keeping us all very engrossed, and no complaints on that.
Most certainly, yeah.
Yeah. So, Neeraj, I think it's also a function of the fact that there are global tailwinds, and growth in the global economy has been better than expected. So you do see even the U.S. markets buoyant, almost new highs in a lot of the segments, and that I think ex-China, I think the situation is turning into a risk-on kind of a mode, and India is part of that, I think.
Actually, Mihir, I was going to ask you that, because you look at this cross-market, cross-asset classes, cross-currency linkages so well. China, for all the fanfare that people had at the start of the year, and I'm not saying they were wrong, for a while the market did well, but then it's given off as well. Does that take away one key option for emerging market investors. Part one of my question is that, but part two is also this. A lot of people say that for EMs as an asset class to get money, China needs to do well. If China is not doing well, does this mean that foreign flows into other emerging markets like India will also be subdued?
No, I think in the last 3 years, this trend of EM ex-China is picking up, and I read a recent couple of articles also where we actually see acceleration of flows into global funds ex-China. So given the geopolitical and other uncertainty regarding the status of China, openness, etc., and the fact that, of course, China is still not picking up as expected, probably we are seeing a delinking of China from the rest of the emerging markets, and India being the largest one seems to be the natural beneficiary. Though, as a caveat, we should not get euphoric because it's not like we are seeing big inflows from FIIs because of that yet. But I think once a trend starts, and if it becomes a longer-term trend, then we can see disproportionate amount of money in the coming few years. So I'm positive on this trend, though we are not yet seeing that translate to FII numbers.
Got it. Me, the other aspect is, and you would have, I may not have seen a tweet from you, but you have some strong thoughts here, I'm sure, which is the borrowing program announced yesterday by the government, much lower than anticipated in the surveys. The yields have reacted duly. Is this a one-day positive, or do you believe that there will be some more positive implications of what the government has announced last night?
So I think like in the budget, the government seems to be far more constructive on the growth, nominal GDP growth rate, and which basically means that they are expecting buoyant tax collections and robust profits and income rises. And that's the reason why I think they are able to be comfortable as far as the borrowing numbers are concerned. And these numbers can always be revised, but by default, I think the government seems to be sanguine about growth prospects for FY25.
Okay. Me, last question. How do you pencil in what could happen to earnings over the next 1 or 2 quarters or maybe 3 quarters, considering that some of the commodity costs have in some fashion come back? Because for the markets to stay atop the mountain that they are standing at, the earnings growth will need to chip in. Are you a bit, how do I say, worried about that aspect, or are you sanguine about it?
I think commodity prices have crept up, no doubt. But since we discussed that China is still not picked up, and China is by default the largest commodity consumer for most of the segments, I don't think we are still in an alarming zone as far as commodity inputs are concerned. I'd be more concerned about the pickup in the rural and the lower income segment categories, because the K-shape still seems to be around, and while the predictions are good for a good monsoon this year, we are keeping our fingers crossed, and I do hope that the K-shape becomes more even.
Sorry, this is my final question. We've taken 5 minutes of your time. Just one more question, and it is this. A lot of people off late have come in and cited some telltale signs which make them believe that the markets may quote-unquote crash. I mean, promoter selling or PE fund selling of companies in a big way, large blocks happening, valuations looking slightly expensive. And everybody says when typically all of these things happen, the markets tend to correct quite swiftly. Do you echo that view because of those signposts, or is your view different?
So the markets can, correct sharply or crash, as you mentioned, only if there is indiscriminate selling. So far, the selling is in the form of QIPs or follow-up offerings or exits through IPOs and block deals, which is more organized and planned out. So it's not like these people or funds or promoters are desperate to sell. But since valuations have reached a certain level, obviously there will be some encashment. So I don't think it's like a desperate selling or anything like that. People are price sensitive, and as long as that's the situation, we should be fine, given the fact that the structural domestic inflows that we talked about, the SIPs and the pension flows and the insurance flows, those continue. So it's, I think, part of life, I would say, especially when the markets have done so well for so long.
Got it. Meir Vora, really, really appreciate you joining us today on an important afternoon, I might add. Thanks so much for taking the time out. That's the view from Trust Mutual Fund. Not too perturbed about the quantum of block deals and sales that have happened. And that's the view from Mihir Vora. As we take that break, though, keep in mind that the markets have cooled off a little bit, and pretty swiftly, I might add, from 1.65 to 1.11. Actually, Rajesh, can I quickly get you in for a question before we take that break? This last 10-15 minutes, this very swift pullback, unnerving, or do you think it's okay?
So this is a normal behavior on expiry days. A lot of rollover activities still pending. So I think that effect is going to take place, and little volatility is likely to be there for next couple of, this for half an hour. So I think this half an hour is going to be volatile, as most of the trades are going to roll over in the last half an hour of trade. So I think that is a new normal behavior for the expiry day. I think still we are holding 22,300. So I think there is no as such worry in terms of trend of Nifty. So that level needs to watch whether we able to close above that level or not. Until 22,300 is intact, there is no worry in terms of trend of Nifty for going forward.
Okay, Rajesh, stay on. Lots more to talk about. We'll take a quick break. We're talking about derivatives on the other side. Agam joins in to put the derivative picture into perspective on this expiry day. We also get in Sunny Agarwal to talk about some stocks fundamentally. Stay tuned, viewers. Welcome back, of course, viewers. Private banks seem to be giving it up. You look at what's happened to Kotak Bank, maybe HDFC Bank, maybe some others. Look at the Nifty private bank chart. Just come off completely and flattened out. So much as there was a lot of fanfare around how well the markets were doing, just come off. Somebody who can put that into perspective very, very well is my colleague Agam. And Agam, on an expiry day, volatility is always anticipated, but just on the last day of the financial year, maybe there is some method to this madness.
No, this one is probably going to beat me, Neeraj, because the last, 10 odd minutes have been, quite something, considering the kind of sharp fall that we've seen in the markets. But, I'm not going to hazard any guesses. I'm just going to tell you how things have shaped up right now. So the Nifty at the moment has lost 1% in the last, I would say 10 odd minutes, and it has moved from the mark of 22,500 all the way down to around 22,274, as you can see here. Rollovers have picked up substantially, and I reckon that this number will move over the mark of 60%. But it is the intraday chart, and the sharp fall and on huge volumes is perhaps what is going to take a lot of traders by surprise. But let's move on and talk about the Bank Nifty, because that's where the real correction has come from day's highs as well. The Bank Nifty also was up around 1.5% at one point in time, and now it is standing at gains of just about 0.5% and losing out. And in fact, the 47,000 mark again in danger. Sure, the April series is adding, but the addition here is not as high as what we had seen earlier in the day. Options markets are going to be a completely different picture for the Nifty, and in terms of change, as one might expect, considering we are sharply coming off from the levels of 22,400, 22,500, is the reason why we have seen a little more in terms of call writing coming through. A lot of these traders who have written the 22,300 and 22,400 puts, they are now trapped as we speak, which means that they will be forced out of their positions in the next few minutes. And of course, this is your overall distribution. I reckon that at this point in time, it becomes a little less relevant, considering we are just in the last 15-20 minutes of trade. Let's move on and talk about a handful of other factors. We are keeping an eye on some longs in Cipla and HPCL as we move into a new financial year. Persistent Systems and SAIL, along with Chambal Fertilizers, looking at some amount of shorts, and that's how we have it. So the picture in the markets has certainly changed and become mixed, and that sharp reaction in the large caps in the last 15-20 odd minutes is potentially the reason why we are seeing a little bit of a come off when it comes to the benchmarks.
Agam, thanks for putting that into perspective, but clearly the last few minutes, and bring up the Nifty yet again, just the intraday of the Nifty if we can, just to show you how sharp this pullback has been. Sunny Agarwal, Head of Fundamental Equity Research at SBI Cap Securities, with us on the show as well. Sunny, good afternoon. Very, very interesting gains in the better part of the trading day today. Before we've come off a little bit, are you constructive as we enter the earnings season? What pockets are you looking at, Sunny?
Yeah, good afternoon, Neeraj. First of all, good to see that market is ending on green note in the Holy Week, especially on the last trading day of the fiscal year. Coming to the earnings season, I think the sector to look out for the upcoming earnings season is auto and auto ancillary, wherein I feel that the way volume numbers are shaping up in the two-wheeler and passenger vehicle segment, so those companies will continue to report a healthy set of numbers for the March quarter. And hence all the auto ancillary companies which are predominantly supplying to two-wheeler and passenger vehicle segment, those will be the companies where we will see a healthy earning growth. The second sector where I feel the numbers will be good is the port sector. So companies like Adani Port, JSW Infrastructure, or for that matter, Gujarat Pipavav Port, all these companies, I again feel, looking at the robust volume growth which we are seeing on month-on-month basis, these companies will continue to report a decent set of number. I think in addition to that, I think we will begin with an IT sector. So few sectors which I feel will be more of a in line with expectation number will be kind of IT and banking, where we all know that both these sectors are grappling with their individual issues. So IT sector struggling with the discretionary demand environment. And at the same time, banking sector, we all know that the net interest margin will continue to remain under pressure. At the same time, because of the regulatory action, we will see some slowdown in the growth in certain pocket as far as the banking sector is concerned. Cement and FMCG, I feel cement, we all know that during the last 2-3 months, we have seen a multiple price cut, especially in the southern market. So cement may slightly disappoint on a margin front. So again, kind of neutral view as far as cement sector is concerned. FMCG, I feel the story is that urban market premiumization story continue to do well. If somebody want to ride a consumption story, maybe travel and tourism is a place to be in, wherein I feel again the numbers will continue to remain robust as far as travel and tourism sector is concerned.
Got it. Okay, Sunny, PSU banks have done very well today, presumably on account of the yield movement. Do you have a favorite out there? Do you like the space?
Yeah, so again, so PSU, within PSU, I would like to go with a larger name like Bank of Baroda, Indian Bank, Union Bank, and Canara Bank. I still feel that there is a valuation catch-up yet to happen along with the private sector bank. So it is recommended to stay with a larger size bank which have got a capability to mobilize low-cost deposit and at the same time protect their net interest margin over the period of next 2 to 3 quarters.
Okay.